White House Council of Economic Advisors, Stephen Miran. And okay, maybe now, but they're going up any time now, Stephen. One of these CPI or PPI prints is going to be frightening because of tariffs. No, we've been waiting and waiting, and you're telling me that prices have actually been declining.
Good morning. Thanks for having me. Yeah, so what we did was we looked through the details of the PCE inflation data and CPI too, and then at every good in those data, we looked at its subcomponents. And so what goods are, what parts are originating in the U.S., what parts are originating abroad. And so we're able to really get into a holistic measure of how much everything is imported. And what we found, and this paper's on our website now, you can find it on the CEA website, on the White House website. What we found is that since December, and you have to compare since December because tariffs began in January, since December, the prices of overall goods in the PCE data have gone up by about 0.4%. Meanwhile, the price of imported goods, and that again includes all the components and the finished goods, the price of imported goods has gone down by 0.1% in this time. So not only is there no evidence that tariffs are leading to significant price pressures for imported goods, but we're actually finding the opposite in the inflation data. And this helps explain why overall inflation has actually been extremely tame since the president took office.
And that's core as well. I mean, I can understand maybe from energy, but it's core as well, Stephen?
Yeah, so if you look at the paper that's on our website, what the numbers that I just gave you are for overall, but we've got numbers for core too, and a similar pattern emerges in core, where maybe instead of the overall price going down for imported goods, it's relatively flat, whereas the price for overall goods has gone up by more. But you still see the same wedge by which domestically produced goods have gotten expensive, have had more inflation, much more than domestically produced goods, which are exhibiting none whatsoever.
But this doesn't mean that it's not still to come. I mean, we can't completely dispel all the fears, because many people have said, well, it just hasn't happened yet. When we get some of these cooler inflation numbers that we've seen that have been really great to see, obviously, but there's always that caveat that, okay, it just the effects of the tariffs is just not there yet.
Yeah, I'm sorry, let me just correct what I just said. The price of domestically produced goods has gone up by more than the price of imported goods. So it's still consistent with a pattern by which there's no inflation driven by tariffs. What you just said is, won't it come eventually? And I mean, sure, eventually, a meteor is going to strike or whatever, but we've been waiting, and it's been many months now, and that evidence has just not emerged. There's no sign of it in higher frequency pieces of data either. Like you see the various research put out by academics where they use scanner data. That just looks like noise and mean reversion. There's no sustained pattern of a tariff-driven price pressure anywhere. And the same thing happened in 2018, 2019, where critics claimed that there would be some sort of huge inflation, and we kept waiting and waiting and waiting, and it never happened. But
Stephen, we've had, the president has put off and delayed some of the implementation. Whenever we talk tariffs, we slap tariffs on, but we've delayed the slapping of the tariffs a couple of times. If they were all to go in and reciprocal tariffs were actually in force, and if we don't make any deals by whatever the next deadline is, would you still expect it not to be inflationary?
Well, I've always maintained that there could be volatility in the inflation data, just as there's been volatility in some financial markets or volatility in some other economic data. As you saw with the Q1 versus what it looks like how Q2 is shaping up much stronger from a GDP perspective. I've always maintained volatility was possible in the price data too. However, I do expect, based on the basic economics of what economists call tax incidence, whereby the party that's more inflexible ultimately bears the burden of a tax or a tariff, I've always expected in the long run that foreigners, that countries were tariffing, would bear the burden of the tariffs. Now, that was a long-run argument. What we're seeing so far is that even in the short run, there's been no pain for American consumers at all.
Maybe the short run is too short, though, Stephen. What we've heard during earnings season from companies is that there was a pull forward of goods, and that perhaps, maybe now, those goods that had been pulled forward, ordered early, extra inventory brought in to avoid tariffs, that inventory level is now low or gone, and so the impact will now be passed on. Do you discount this notion of pull forward and selling those goods that had yet been tariffed?
Well, the only thing I can say is that we've seen no evidence of price pressures to date, either in the official data or in some of the unofficial, much more high-frequency data that are studied from individual stores that are studied by academics. And so, as a result, all I can say is we haven't seen that yet. Is it possible that we ultimately get some volatility in prices along the lines I described before? Sure, it's possible, but other things are possible too. Rare events happen. We get pandemics or meteors or whatever. So look, it could happen. I'd never say never, but nevertheless, there's just no evidence thus far of it happening.
But I mean, if you're going to compare it to a pandemic or being hit by a meteor, then it seems like you're really saying that it's probably not going to happen. It's very unlikely, and that pull forward of inventory, it may have happened, but it's not going to result in ultimately prices down the line being raised on consumers. Is that right? I mean, when I hear hit by a meteor or things like that, it sounds dismissive.
No. Sorry, I don't mean to be dismissive. All I mean to say is that prediction is difficult, and we should always speak in terms of odds and possibilities and probabilities, never in terms of deterministic. Like, I don't have a crystal ball telling me the future, and neither does anyone else. All I can tell you right now is there's no evidence of it thus far. It's possible it could happen, but we just have there's no basis in data for saying that that's the case. There's no data that would support that position thus far.
Yogi. Primarily predictions about the future are difficult.
They're tough, and lots of economists pretend that they're much better than they are. You know, the idea of giving a precise point estimate when the uncertainty intervals are so wide has always just struck me as nuts. And I think that economists should generally be humble, and that's why I'm framing things the way that I am.
Right. Why the outlook going forward is always more difficult than the outlook going backward.
Of course.
Because we know about it, that. I mean, the way we talk in this business, Stephen, let's talk about the OBB. Is it the OBBBB, OBGYN, the big, beautiful bill? It's so much conjunction. See Larry Summers. Wow, he thinks it's dangerous. Imagine that. Would you make the case, Stephen, and I've been making this case, that none of us like deficit spending, and maybe you argue that that it's not going to be deficit spending, or maybe the deficit will come down from the growth aspects of this, but maybe not all deficit spending is equal. If you deficit spend and just blow out a bunch of programs with the IRA or New Green Deal or whatever, versus cutting taxes and leaving capital in the private sector, maybe to do things with and maybe to grow the economy, there's a difference between those two types of deficit spending, isn't there?
Oh, absolutely, absolutely. And so using government money to fund, what may or may not be economically productive activities. And so you mentioned, some of the Green New Deal activities. I don't think the government has any edge whatsoever in predicting what kinds of cars consumers are going to want 5, 10, 15 years from now, whether those are electric or gas cars or coupes or sedans or convertibles or pickup trucks. The government really does not have a historically strong track record of predicting those things, which is why many industrial policies targeted at specific sectors can often end up failed, as you see, for example, in China, where they have empty cities of apartment buildings that nobody wants. Or that nobody can use. Whereas what's going on in the One Big Beautiful Bill isn't an industrial policy targeted at a sector that the government may or may not have a good sense whether it's a productive use or not. What's going on in the One Big Beautiful Bill is a generalized incentive to investment, but one that gives firms the ability to choose what they're investing in based on their knowledge of their markets. And so full expensing on new factories, full expensing on equipment, full expensing on R&D gives firms extremely powerful incentives to invest and to build out the capital stock of the United States so that we get more production, so that we get a more productive economy, better labor productivity, higher wages, lower inflation, higher GDP growth, right? But it lets firms choose what they're going to invest in, which is exactly what you want to do, because that's the basis of capitalism. That's the basis of a market economy, that households know what's best for them and firms know what's best for them, not the government.
The Treasury Secretary has argued several times that that you actually see the deficit shrink, and God help us if it doesn't shrink. What are we at in terms of GDP, 6 or 7% or something? But when you're spending, it's hard to see how that would really happen. You're assuming that there's going to be enough growth in tax receipts that the deficit comes down, or because it doesn't seem like there's that much spending the cuts aren't as much as a lot of fiscal hawks would really like in this.
Yeah, sure. So, look, we estimated, and this paper is also on our website, the One Big Beautiful paper and the One Big Beautiful chart book. We estimated that the totality of the President Trump's policies would bring down deficits relative to the tax hike baseline by about $8.5 to $11 trillion over a 10-year period. And let me break down where that comes from. We have our policies between the tax bill, the incentives for investment that we mentioned before, things like no tax and overtime. These are actually quite stimulative. Between those and deregulation, which is also extraordinarily pro-growth because companies often don't build things because they find a snail. But if you make it so they can build things, you get more buildings. So between tax, deregulation, and energy abundance, we have GDP overall going up by about a point a year over the course of a 10-year window, which creates about $4 trillion of revenue from better economic growth. We've got a further $3 trillion of revenue from tariffs. We've got a further $1.5 trillion of reductions in spending from cuts that are in the pipeline from the budget that the Office of Management and Budget put on its website a few weeks ago. As well as from the efforts of DOGE reducing federal headcount. That adds up to a lot over 10 years. And then finally, because you're doing all this reduced borrowing from those savings, you've got lower interest expenses too because there's less debt to service. So that's about $1.5 trillion too. So you add all these four things up, and you get to about $8.5 to $11 trillion. Again, as I said before, I think economists should be humble and not give a precise amount because there are ranges about how, there are confidence ranges around all these things. But you add up all those things, and that's where we end up.